Hello everyone, myself Nitin Sethi and the student ID is 15276076 and today I'll be discussing about the business analytics of the UK banking industry. While talking about the executive summary, this report explores the UK banking industry, identifying the key trends and providing the recommendations for the future growth. Data from frame and descriptive analytics and predictive analytics were used to analyze the profitability across the banks. Factors like profit and loss accounts, turnover, current assets and liquidity ratios, and the operational efficiencies determine the profitability. Recommendations include managing liquidity, reducing high risk variance, and improving the shareholder returns. However, the report includes the limitations as a sample of 10 banks that are limited to the secondary data. While discussing about the literature review, this business analytics faces a challenges such as complexity, time, and effort required to integrate new tools, and the need for data-driven culture, and navigating the data privacy rules and the regulation adds a complexity. Despite these obstacles, business analytics is crucial for smart decision making, planning, operation, and AI-driven predictions. Companies are increasingly using the real-time analytics to stay agile and adapt to market shifts even for small businesses. The benefits of analytics are worth the effort. And while discussing about the industry background, the UK banking industry is experiencing a steady growth driven by the rise of digital payments, particularly contactless cards. Traditional banks are adopting AI and mobile apps to improve the customer satisfaction and speed up the services. However, they face a stiff competition from fintech startups and digital-only banks to stay competitive. Traditional banks are investing heavily in the digital tools, enhancing the customer experience and partnering with the fintech companies. They must balance and embrace the new technology with maintaining the traditional values to stay ahead in the market. And while discussing about the visualizations, like taking a quick look of the financial performance of some of the major UK banks based on their average values, we can see that some of the interesting trends starting with the profit margins. NatWest Group is leading the pack with the impressive of 49.69%, closely followed by the Royal Bank of Scotland at 43.1%. However, the Metro Bank is struggling with a negative profit margin of 21.7% in a minus, highlighting some significant challenges when it comes to the workforce size. HSBC Bank takes a top spot with a massive 244,630 employees, making it one of the largest employers in the sector. On the other end of the spectrum, the Royal Bank of Scotland has a much smaller team with just 885 employees. This number shows that the diversity in the scale and the performance across the UK banking industry. When it comes to the turnover, HSBC Bank is once again at the top and bringing in 54.46 billion pounds, followed by the Barclays with 27.19 billion pounds. Lastly, if we look at the current assets, both Lloyds and HSBC stand out with the massive holdings. Each has over 980 billion pounds in assets, showing just how strong their financial positions are. This numbers paint a clear picture like how different these banks are in terms of performance and scale. Each one has its own strategy in place in the market, reflecting the diversity of the UK banking industry. And while discussing about the descriptive analytics of the UK banks that we have analyzed, while taking a look of it, the statistics of the data of all the 10 banks based on the average profit margin is around 15.27%, but there is a lot of variation from the range of minus 58.57% to 91.65%. The number of employees varies widely from as low as 16 to over 268,000, showing a big difference in the company size. Turnover and the profit after tax also shows a huge gaps, meaning some businesses are performing really well while others are struggling. Looking at the skewness, and we see that the profit and the loss account, turnover and the profit after tax are heavily skewed to the right, meaning few companies have very high values. On the other hand, return on shareholder funds is negatively skewed, meaning most of the companies have lower returns, but few have an extreme values. Overall, the data shows high variability with some firms making a big profit while other faces losses. And while discussing the correlation matrix reveals a strong positive correlation between the number of employees and the turnover, suggesting that an increasing in the workforce lead to a higher turnover. A strong positive correlation of 0.91 between the number of employees and the profit of loss account indicates that the businesses with the more employees have higher profits and loss accounts due to increased operational capacity. However, a negative correlation of -0.21 suggests that slightly increasing the workforce may lead to decreased liquidity due to high salary expenses and the working capital requirements. A surprising a negative correlation of -0.22 suggests that companies with higher current assets may not necessarily have more liquidity depending on the composition of the current assets. And while discussing about the linear regression shows that a strong R squared value of a 0.83, which means that 83% of the changes in the dependent variable of profit and loss account can be explained by the independent variable number of employees. This tells us that the model is a good fit for the data. Additionally, the p values which is much lower than the standard threshold of 0.05. This indicates that the number of employees has a significant impact on the profit and the loss account. In simple terms, the more the employees a company has, more it tends to influence its financial performance, and its relationship would be statically meaningful. And while discussing the multiple regression, which the result shows that has a decent R squared value of 0.66, meaning that 66% of the changes of the dependent variable profit after tax can be explained by the combination of independent variables. This suggests that the model is reasonably a good fit. Among the variables, the profit and the loss account has the strongest impact on the profit after tax, with the p-value below of 0.05, making it statistically significant. On the other hand, the number of employees have a slightly negative effect, meaning that as a workforce grows, profit after tax tends to dip a bit, likely due to higher cost. The overall significance of F value is 8%, which is just above a 5% threshold. This means that the model isn't highly significant, but it's close, indicating that relation it highlights are still worth considering. In short, while model isn't perfect, it gives us a useful insights into what drives after like profit after tax. And while talking about the recommendations, here are some practical recommendations based on the findings. The bank should focus on better liquidity management, managing financial risk from variability, and increasing shareholder value without compromising profits. Excessive liquidity can sometimes harm profitability, so banks should aim for balanced approach to stay stable. And banks also should focus on the strategies to reduce the risk and create predictable outcomes. Additionally, banks should explore a way to boost shareholder value while maintaining a strong financial performance. In summary, banks should aim to balance the liquidity, manage the risk, and find a smart ways to reward the shareholder funds without compromising their financial health. By doing so, they can ensure the better financial performance and the long-term success. And when talking about the conclusion, the UK banking industry is rapidly evolving due to new technologies and the regulation. To stay competitive and efficient, banks are utilizing the descriptive analytics to focus on key financial metrics like liquidity, shareholders, returns, profitability. Business analytics also helps the banks to understand the data, improve financial performance, and streamlining their operation, ultimately ensure their continued growth and success. And these are my references. Thank you.